Every day, traders wake up and chase what's moving. This morning, TSLA, NVDA, MARA, Coin, GME, Riot, big volume, and for most, that's all they need. But that's not trading. That's gambling on noise. Volume isn't the story. Liquidity tells the tale. Real trading is about context, and this week, context is everything. Behind the pre-market hype, we track something smarter. Institutional liquidity, not just volume. These aren't random spikes. These are levels where capital has already committed. We call them institutional liquidity levels, but think of them as the gravity wells of real price action. Private institutional exchanges are the real market movers. Follow the money. Here's what the data says. IWM is sitting above 10 institutional levels. SLV, same. FXI, same. But the follow-through, minimal. In contrast, GBTC is above just one key level, and it's hit 4 of 5 bullish targets. JPM hit 3 of 5. EM, 2 of 3. These names didn't just show up, they followed through. That's the difference between volume and velocity, between activity and accuracy. So we track how many institutional levels price is above, how many bullish targets have been hit, and what action grade each ticker deserves. Strong, stalled, weak. This week's action makes more sense when you zoom out. We're sitting in a late-stage euphoric expansion, according to the Benner, Anderson, and Elliott wave cycles. These cycles don't guess, they map the psychology of the masses. And right now, that psychology is stretched. The market is stretched, so are the risks. Retail sentiment is high, crypto is back in fashion, meme stocks are seeing life, and yet institutional money is hesitating. That's not a contradiction. That's a signal. We're in the calm before the macro storm. Don't get caught in the rush. Late cycle behavior is exactly this. Price extends, but breadth narrows. Participation thins. Momentum becomes fragile. We see it in the 1 for 5 hit rates on names like SLV, XLF, and ARKK, despite major institutional liquidity stacking. We're in the calm before the macro storm. The Fed is keeping rates high and liquidity low, despite the soft landing narrative. This isn't accidental. They're controlling inflation optics, not easing the cycle. At the same time, media volatility is rising. Trump headlines dominate. Crypto chatter spikes. But here's the truth. News doesn't move markets. Liquidity does. Smart money doesn't trade headlines. It prepares for the long game. Institutions aren't reacting to news. They're creating it. In the long game, it's pointing to a downturn between 2026 and 2030, backed by both the Anderson crash cycle and Benner's panic prediction. The risk is already being priced into the edges, in credit spreads, real estate stress, and small cap hesitation, like we're seeing in IWM. Most traders lose because they treat the market like it's random. They chase volume, they ignore structure, they don't track probabilities. Retail traders chase noise. Smart money follows the structure. But this isn't random, it's rigged. And rigged doesn't mean unwinnable. It means you have to understand the rules. Think like a strategist, trade like a tactician. So here's how to win. Track institutional liquidity levels weekly. Grade the follow-through. Avoid names with stacking and no movement, they're liquidity traps. Favor names with clean follow-through and strong hit rates. And always align your trades to where we are in the macro cycle. Traders talk about risk-reward, but most don't manage risk, they trade regret. If you want to step out of that cycle, start thinking like a strategist, not a spectator. This isn't a market, it's a game of strategic positioning. This isn't just trading, it's sovereignty. And it starts with seeing what others don't. Volume is the echo, liquidity is the signal. Now go find your edge. Take action today. Come trade with us at expertradei.com.